Hello everybody, welcome to another episode of EricksonTV. Curtis here with Lauren. Hello Lauren.
Hey Curtis, hey everybody.
Hey Lauren, this was just discussing the current affairs of the 401k balances, and it comes from Fidelity, which is one of the larger custodians of 401k plans,
right.
And it was published in today's USA Today. And so the way the article reads, the title is "The Average 401k Balance Soars." So it sounds positive.
So it's gone from 0 to
well, almost. So back in 2009, of course, when the market was at lows, the average 401k balance was about $46,000.
Okay.
And now, at the end of 2013, it's up to about a record $89,000 per participant.
Okay.
Now that sounds good initially, but that's just in 2013 alone, that's a 15.5% increase. But when you start reading the numbers, there's a couple of alarming things. They say that 78% of that increase in the balance comes from just the market growth. It was a big year in the market.
Yeah. Okay.
So only 22% was from actual contributions.
Right.
But the more disturbing thing is that in the year 2013 alone, more than 35% of all 401k participants cashed out their accounts. And that number is even higher from participants aged 20 to 39. Okay.
Right.
And so what they're saying is that the average 401k that was cashed out, and it usually happens during job changes, was about a little over $16,000. And this is the message of today is about we always talk about working with advisors to help eliminate the great mistakes.
Right.
There's always it only takes one or two big mistakes to really devastate your retirement. And they do. I think they do a good job here. They say that if the average younger investor that maybe 30 years old, for instance, they might be looking at, well, this is $16,000 that I can use money for, to pay down debt or whatever. But what they don't realize is that if they kept that invested, and then that retirement, that could work out to be about $461 in monthly income at retirement.
Right.
And they also, the other bad thing, of course, we know about this with our tax background, is that, you're paying an average of about $3,200 in federal taxes on the withdrawal, and another $1,600 in early withdrawal penalties.
Yeah. So I was just doing a financial planning meeting with somebody who's a little bit younger than I am, so early 30s, and we were talking about 401k plans, and he was talking about how he didn't want to save this money because it hurts to save it, and then you can't touch it for all these years and all this stuff. So I did this little thing in Excel where I showed him, if you make X% per year or whatever, and you keep putting in $5,000 every year, where do you end up? And after 10 years, you end up in a very similar situation to how much money you put in. If you put in $5,000 every year, you ended up, I think, in the example, you ended up with about $80,000.
Right.
After 30 years, if you put in $5,000 every year, you put in $150,000 total, and you ended up with over $400,000. And I was, using real returns, not.
Right.
And that was a real eye opener for me. He was like, wow. And I said, yeah, wow. I mean, basically, you can either start saving when you're young, or you can save a huge percentage of your income when you're older.
Right.
Those are your two choices.
Right.
And I mean, if the second choice is what you want to do, that's fine. But I don't really feel like most people are actually thinking that through or making that decision.
Right.
That's not how things are going. They're just sort of, thinking, oh, well, I can use this money right now.
Right. Well, there's a contradiction, too, with the youth of the world. We're starting to work with a lot of younger investors, thankfully, now, which I think is good to help them when they're younger. But, it's interesting, and I'm being generalized. I'm using it in general, this is not for everybody, but a lot of them are very cynical that there's going to be Social Security for them.
Right.
But then at the same time, they're cashing out the 401k balance, so how are they going to have a retirement?
That's a very, very, very good question. And I think maybe some of that is just sort of like that cynicism is just sort of an excuse to not think about it or not worry about it or whatever.
Or put it off.
Put it off. Yeah. That's not the best way to look at things.
So to end this episode, I don't want this to come out as self-serving, but my other take is that a lot of these 401k plans are being set up purely looking at the expense ratio and not working with advisors, for instance.
Right.
It's more. It seems like it's going more to this do-it-yourself, self-direct type of planning. And I think that's encouraging or assisting or facilitating these big mistakes happening. That to me, I think you agree with this, is that the reason to work with an advisor like us is that we want to help you avoid these great mistakes. And so for our clients that are watching this that maybe can influence a son or a grandson or a friend or a neighbor, encourage them to get planning help, because hopefully that will help avoid these great big mistakes.
Yes.
Thank you very much for watching this episode of Erickson TV. We'll see you next time. Bye now.
See you next time.